So tonight's lesson is on the equation analysis sheet. Simply what an equation analysis sheet, it's a tool for displaying individual transactions using the fundamental accounting equation, and it gives you a picture as to how the financial position of a business is changing as a result of that transaction. I'll be using the example in the textbook, Metropolitan Movers. So you see here the balance sheet for Metropolitan Movers as of September 29th. And then down below, we use the fundamental accounting equation, assets equals liabilities plus owner's equity. And then all the accounts are separated. So the cash account is separated from the accounts receivable accounts from the two different people. Equipment, truck, and then liabilities are separated by accounts payable, bank loan, and then owner's equity. Now we get to our first transaction. Metropolitan Movers pays $1,200 cash to reduce a bank loan. So you're going to see our cash account reduced by 1,200, and then we also have to reduce our bank loan by 1,200. Notice how we haven't, no other accounts were affected. So the two accounts receivable accounts, the equipment account, trucks, accounts payable, and owner's equity were not affected by this transaction. In the second transaction, we have this person, Kay Lincoln, who owes Metropolitan $2,500, pays $1,100 in partial payment of their debt. So we're the company is going to be receiving $1,100, and now when you do the subtotal again, it now gives us a new cash total of 13,400, and then we go to our the accounts receivable for K Lincoln and reduce the amount that they owe us. So they owed us 2,500, they paid back 1,100, so now they only owe us 1,400 now. Transaction 3, Metropolitan buys some equipment and they purchase it with cash. So now we have to reduce the cash account by 1950, and then we have to increase our equipment account by 1950. In transaction number 4, Metropolitan buys a pickup truck, of which it costs $18,000. They have enough for $10,000 to pay in cash, and then they have to arrange a bank loan. So here's how the accounts are affected. So the cash account goes down or is reduced by $10,000. The truck account is now increased by $18,000, the value of the truck, and then we also have to show an $8,000 loan under bank loan. Transaction number 5, Metropolitan completes storage service for B Cava at a price of $1,500. A bill is sent to Cava to indicate the additional amount that is owed. And notice this transaction is a little bit different. So we have an accounts receivable account for this particular person, B Cava. So that account is going to go up by $1,500. And then when you look on the right side of the fundamental accounting equation, there's no accounts that sort of correspond with this. So the resulting account that is affected is the owner's equity account, and it goes up by 1,500. So this transaction, the owner of the company, Jay Hoffner, withdraws $500 for personal use. So this is very similar to transaction number 5. The cash is reduced by $500 here, and thus your owner's equity is reduced by $500 as well. And the final transaction, number 7, one of the trucks requires an engine adjustment costing $375. The repair is paid in cash when the truck is picked up. So we're paying cash, which means it reduces the cash account by $375. And in this case, because there's no account related to vehicle expense or anything on this side, so we take it out of owner's equity. So the owner's equity is reduced by $375. So once the all the transactions are completed and you have new balances for all the accounts on using the equation analysis sheet, you can then compile or create a new balance sheet. So here's the new balance sheet for Metropolitan Movers as of September 30th, no longer the 29th. So after one day, this is what the new balance sheet would look like. So in summary, here are the summary steps of in analyzing a transaction. 1, identify all asset and liability items that must be changed and make all necessary changes. Is it an asset account or is it a liability account that's being affected? And then you have to decide which item that is affected, is it to be increased or decreased? C, if the owner's equity has changed. This means you'll have to use the fundamental accounting equation. In general, if the business's financial position is better off after the transaction, the owner's equity has increased, and vice versa. Step three, make certain that at least two of the individual items have changed. You may have several accounts that change, but you can never have only one that changes. And make sure that the equation is still balanced after all the changes are made. So that's the end of the video. Again, your practice should be making your own notes on the video, coming to class with questions. If you don't have any questions, perhaps make up your own example or make up potential test questions.